Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari.
Hello.
What's going on, Hari?
Not much.
Not much, huh? We are already in August.
Yeah.
Isn't that crazy?
It's it seems like coronavirus has been with us for forever now.
Yeah, it seems like coronavirus is like warping time.
Yeah.
For me, I can't believe it's already August.
Yeah, for sure.
Yeah. Anyway, this episode we will be talking about Sherwin-Williams. So let's get right to it. Hari, can you give us the disclaimer?
Yeah, this is the Value Investor TV podcast. We are the podcast that helps you understand the concepts behind value investing. We are not financial advisors, nor do we know your specific financial situation. So please consult with the appropriate advisor before making any financial decisions.
Great. Awesome. All right. So as we always do, we'll go down the checklist to analyze this company, Sherwin-Williams. I think it's an incredibly exciting company. People might not think that, but I think it's an exciting company. They make paint. Very simple business. But if you guys want access to the checklist, please email us at info@valueinvestor.org. We'd be happy to share that with you guys. info@valueinvestor.org. Also, if you want to be involved in our Slack community, please also email us at info@valueinvestor.org. We'd be happy to send an invitation your way. All right. Should we go down the checklist, Ari?
Yeah, let's do it. So if you are not familiar with this checklist, we use this checklist for every company that we analyze. It's there to help us to make sure that we don't miss anything when we're evaluating a business. And so with that, Becco, let's tell us what Sherwin-Williams, the company, does. You should be able to answer this question in less than 2 sentences.
I noticed that you emphasized the last part of that question.
I did, because I've had enough dissertations about companies before.
Would you like a lecture?
Yeah, I think they make paint is enough, actually. But if you want to elaborate, go ahead.
I think that's pretty much it. I mean, really, I don't know what else I would say in addition to that, really. They make paint, and they make coat, protective, marine products, related finish products. It's like a subsection of the Lowe's or something where they sell paint. That's all they do. They have their own retail stores. They also distribute through companies like Lowe's or Home Depot and things like that. They operate in North America and in Latin America, Caribbeans, mostly in this side of the world. Yeah, that's about it.
All right. Well,
maybe just the level set really quick. Just really quick, the level set on to know how big this company is. Just roughly, the market cap is around $60 billion, and they have around 60,000 employees. And just for additional context, they've been around since 1866, so quite a while.
Well, I think
how was that?
That was perfect. Actually, I think you
okay.
you got it under. It's a little over 2 sentences, but I'll allow it.
You let it slide.
Yeah.
You let that one slide.
I'll let it go. Because
okay.
I mean, the only thing I'll say to this is, for those of you who are fans of Peter Lynch, this would be one of the companies that he would love, because the more boring the business, the more exciting the investment, which is what usually happens. So, but we'll talk about why that would be the case here shortly. Okay, so one of the main things that we try to identify is the competitive advantage for the business. And the competitive advantage allows them to do lots of things, but can you kind of give us the competitive advantage based on what category it would fall under? So do you think that the Sherwin-Williams has a brand moat or brand competitive advantage based on their brand?
I think so. I think this is the strongest moat, perhaps the only moat that they have that can really leverage, in my opinion. So they not only sell Sherwin-Williams branded products, but they also have a portfolio of brands that they own and operate. And these are pretty well known in the industry. People love it. Also, customer segment, I think we need to talk about that. Customer segment that they target is um, you know, paint enthusiast, DIY enthusiast, people who like to decorate and renovate their houses and things like that. That's one aspect of their customer segmentation, and then the other aspect is professional folks who paint for a living or do finished products for a living. Anyway, going back to the brand conversation, yeah, this they this is the thing that they espouse all throughout the whole 10K and SC filings, and in fact, I think it is true that they have a brand advantage out in the market compared to others.
Okay. Um, you know, we talk about um, the other types of moat here to see if there is a benefit here. So, do you think that there are any network effects associated with Sherwin-Williams? I mean, because other people are customers of Sherwin-Williams, will people want to be customers of Sherwin-Williams?
I don't think so. Yeah, I don't think there is any network effect here.
Okay, I think that's pretty reasonable. There any switching costs associated with being a Sherwin-Williams customer?
Not really, right? If you buy a paint from Sherwin-Williams and buy it from Benjamin Moore's, there's no switching cost on your part. Switching out paint is not such a big deal, right? So,
but when you talk about the professional segment, are there large accounts? Excuse me. Do they have some sort of benefit or discount if you are buying from them? Do they have a corporate loyalty card or anything like that? Or
yeah, that's a good point. They do. They have a portal, mysherwinwilliams.com. It's a portal for the professionals, and you obviously get, like you said, a discount, and basically you can see what's available, and maybe you have first-hand access to the newest and greatest paint or finished products and things like that. Yeah, I would say there is some of that at play. But again, I don't think for them to switch to Benjamin Moore's would be such a difficult thing. I think there is certainly, element of momentum and inertia in things like this, but I don't think it's such a big deal for them to switch over to some other provider.
and do they have any sort of like deals with the Home Depot and Lowe's or anything like that that kind of protects them from competitors, or is this is it mostly just the brand that people are seeking when they go to the Home Depot?
Yeah, I think it's they definitely have a lot of one of the things they kept emphasizing in the SEC filing is that um, in terms of distributors for their products, there isn't one or two dominant distributors that have over 10% of their sales. They kept emphasizing that over and over. And so I don't think that even if, for example, Lowe's dropped out or they gave them favorable coverage for Lowe's, it's going to have any material impact in the overall business health of the overall business.
Okay. Do they have a moat that or a low cost moat that allows them to to undercut their competition?
I don't think so. I don't think so. I mean, I think when you think about paint is really already commoditized in many cases, I think. So I'm not sure if there is any low cost moat. They do, however, they manufacture. They only play in North America. For example, if they were to go out there and compete against the Chinese locals in their own turf, I think that would be problematic. They wouldn't be able to have that low cost or that sort of advantage. But over here in the U.S., I think it's kind of like a hybrid. It's in between Skechers kind of play and and kind of Alta kind of play. I feel like it's somewhere in the middle. And what I mean by that is, paint is already sort of not, you're not talking about luxury good, um, but at the same time, they own the supply chain, they own all the logistics, they manufacture their own stuff. They have their own direct to consumer channel, so omni channel. Um, yeah, all those things. I think it makes it kind of along that spectrum. I think they're sort of in the middle. So going back to the low cost, yeah, I don't know if there is really a low cost moat there.
Well, so when you one thing to think about, and it's not really a low cost moat, but when you have the infrastructure already in place and you're a profitable business, after 150 years, Sherwin-Williams better be profitable. I imagine they are. Um,
Yeah.
it's hard for an entrant to get in. These, if you and I were to go to a venture capital group or to someone else and say we want to disrupt paint, you know, uh, nobody's going to give us money, right? Right. So,
I don't know. We can try.
well, you live in San Francisco, so there are a lot of idiots there. So
uh,
maybe they'll give you money, but I mean, the point is that in order to compete with this business, in order to make even a small dent, right, we would have to have a lot of capital, to even compete with them. So
yeah. On top of that, I would also say they've mentioned several times the environmental regulation
mhm.
to be compliant with environmental regulation in all these different countries where you manufacture and sell paint. Paint is pretty toxic to the environment, right? You got a lot of waste product. So be able to be compliant with all these regulation is a lot of overhead that you need to, like, for example, you and I, it would take tens of millions of dollars just to be compliant. And on top of that, we have to make sales and make profit. So it is an barrier to entry in and of itself, for sure.
Right. Yeah, and so it's really a barrier to entry that I'm talking about here more than anything. That in order to compete, it would be many, many years, a lot of cash to comply with regulations, to build out the infrastructure, and so on. So, okay, going to the last competitive advantage, which is intangible assets. So, do you think there are any patents? We just talked about regulatory hurdles that they've already cleared in order to manufacture the paint. But do you see anything else that you would consider part of the intangible asset that would protect Sherwin-Williams?
Yeah. So obviously, intangible assets. When we think about that, we think about, for example, classic example I like to give in the podcast is patents on drugs. They don't have anything like that. They do have a little bit of business, really immaterial though. Have a little bit of business in terms of licensing technology, trademarks, and trade names to foreign companies. But really, it's immaterial to the business. So I would say a no to this one as well.
Okay. All right. Well, so we're gonna call them their moat here, mostly the brand, maybe some small switching costs, and probably some regulatory benefits that they have from operating for so long. Um, Anything else that you would want to add to that before we move on?
No, I think that's a great summary. Sorry.
Okay. All right. Let's look at the next question here is how durable do we think this competitive advantage is, and what do you see as risks to that advantage?
Yeah. I think it's pretty durable, competitive advantage wise. Just looking back at, of course, past is not indicator of the future. It could change. Things can change. But again, as we talked about, paint is not an industry that would be easily disrupted, and people, do not have appetite to go into paint to disrupt things. So I think what people call the Lindy effect, meaning that the longer you have existed, that amount could also be projected out into the future. I think it applies here. So again, they've been around for how many years now? 140 years. I think the competitive advantage is quite strong in that way. When I was reading through this company and analyzing this company, it really reminded me a lot about what kind of Warren Buffett looks for.
Mm-hmm.
Right? It's a good, strong business that no one really thinks there's anything there, but it's a solid business run by good people. It's been around for a long time. Brand is quite strong, and it's very simple to understand. right? It's nothing complicated. It's just they make paint and sell paint.
Yeah, and I think
Um,
the thing here to say is paint is not going to go away. You still need paint in a recession. Um, you know the at this point, nobody's really trying to come into or is a new entrant into that space. So they're well differentiated because there's a lack of competition. At this point. So
mhm. Yeah.
to me, those seem to be the things that as you said, Warren Buffett, but also Peter Lynch, as I talked about earlier. These are boring businesses that don't have a lot of competition, and so Sherwin-Williams can kind of, I mean, not necessarily set their own price, but they can kind of control the market because of their size and their scope and all that. So
Mhm.
those are obviously good things. Okay, let's look at the keep going down the checklist here. What do you think the company's long-term prospects are? I think we just mentioned nobody runs out of paint or will stop running out of paint, but and what do you think their growth trajectory could be?
Yeah. So just to so I just did a quick Google search on the annual market size for paint. Right, this is annual global market size for paint, just for paint. I'm not talking about finished goods, just purely paint. It's around $150 billion. Sherwin-Williams revenue last year was about $18 billion, meaning that there is a lot of room for growth just internally, right? By siphoning off customers from competition, eating up competition with M&A and things like that, right? So there is a room to grow in and of itself. But and also the fact that paint is not an explosively growing industry, right? It's going to be pretty slow, steady industry. You can probably, if you want to be really conservative, you can estimate to be growing at an inflation rate, really.
Yep.
And if you think that, the only thing that Sherwin-Williams can do is eat up the existing pie. The pie is not going to grow. But if you look at the pie, as I mentioned, it's $150 billion just in paint, an annual runway, and Sherwin-Williams captures about 18 of them. So there is runway for growth, even though the market itself is not dynamic. It's pretty dinosaur like.
Okay. So let's keep going down the checklist because I think the nice thing about easy to understand businesses is that you can get through them pretty quickly.
Yep.
And then we'll kind of summarize here fairly soon. Does the company require a lot of capital to maintain its business, and can it grow without reinvestment?
So to answer that question, let's go right to the CapEx and the cash flow, and figure out percentage of net cash from operation that goes into capital expenditure. So to give you just absolute number, for the past about 5 years, they've invested about $250 million every year in CapEx. If you put that into perspective, it's around 15% of net cash from operation. So there you have it. So about 15% they invest right into the business to grow their operation. And so what that really means, what that translates into in real life, is they close down underperforming stores and they open up new stores. So yeah,
Okay.
about 15%.
Yeah, and we'll come back to this a little bit more when we talk about return on capital. So let's ask a couple more questions here relating to their relationships with third parties. So do they have favorable relationships or any issues that you see with any of the following: customers, suppliers, employees, regulators, etc.?
I don't see any red flags. However, I do want to point out that regulator is something to be aware of. They explicitly have a line item to deal with California environmental regulation. There's a line item called California litigation cost that they report on. So this is something that they seriously, they approach with seriousness. This is a serious matter for them, and so something to keep in mind. I don't think it's going to be a company killer or anything like that. It's something that you have to just kind of anticipate. And one of these years, you might get a big the regulators might take a chunk out of their revenue or something like that. So just to have it on your radar, but I don't think it's going to be a company killer.
Okay. All right. Well, that actually is the takes us to the end of our first episode on Sherwin-Williams. Becco, anything you want to summarize or say before we close out?
No, this was great. I think this is, again, it's a very simple company. Peter Lynch would love this company. Warren Buffett would love this company. Very easy to understand. In fact, I would suggest that people who don't have a lot of experience looking into companies, I would highly suggest that you look into this company. It's quite simple. It's quite easy to understand. Their accounting is quite straightforward. So, yeah, I would highly recommend people to take a look.
Awesome. So just as, to close out here, if you are looking for our checklist that we've been using through this podcast, you can email us info@valueinvestor.org or email us with any questions that you have. We also welcome emails to get onto our Slack channel where our community communicates throughout the, in between podcasts, essentially. So you can talk to us anytime you want on Slack or ask questions, share news, talk about various investment ideas. So we have, we would really like you to be on there. If you're a fan of the show, please email us, info@valueinvestor.org, and we'll happy to answer your questions or add you to our Slack channel.
Awesome. Thanks, everybody. I'll talk to you guys in the next episode.
Thanks.